First rates are in. The Nifty is up close to around 20 points.
The markets are extremely range-bound, very, very quiet. Monday,
the market's absolutely flat on the Nifty.
The Nifty is trading just under its 20-day moving average. That's a level we've been talking about. 18,668 is that number.
Let's focus first on some of those large cap names. The Nifty managed to end in the green. We go home with gains of close to around 30 points.
Well, we managed to end in the green in today's trading session. It was a largely range-bound, flattish sort of session with the mid-caps doing extremely well. The big positive was the Nifty holding above the 20-day moving average and the Nifty Bank holding above the 50-day moving average as well. You're watching us here on Markets Today. We track 6 hours of day's trading action and 5 headlines. Let's talk about those headlines. The Sensex and the Nifty end marginally in the green after a range-bound session, but mid-caps perk up in trade with the index gaining nearly 1%. ICICI Securities hits a fresh 52-week high. The company's board will consider a proposal to delist shares from the exchanges this Thursday. This move is likely to see shareholders receive ICICI Bank shares as part of the proposed scheme of arrangement. The initial public offering of India's largest drone maker, IdeaForge, fully subscribed by the afternoon on day 1 of bidding. The retail portion got subscribed by 7 times. The company, remember, plans to raise 570 crores via this IPO. Bids can be placed till the 29th of June. Infosys rallies after bagging an order worth nearly $454 million from Denmark's Danske Bank, while Apollo Tyres falls over 3% as it reiterates its FY26 revenue target of $5 billion. Shree Cement denies tax evasion reports, tumbles 5% nevertheless. PB Fintech jumps over 6% on a buy rating coming in from IIFL. Tata Consumer also rallies on a positive brokerage view from Citi, while SBI Card tumbles over 1.5% on a brokerage downgrade coming in from Nomura. Let's tell you what we have on the show. It's a packed show. In Market Opinion, we have Jonathan Garner, who's the Chief Asia and EM Equity Strategist at Morgan Stanley. Tahir Bacha joins in as well, chimes in with his views on the market. And in Big Corporate Voices, we have IdeaForge Technologies CEO Ankit Mehta and CFO Vipul Joshi. Let's talk about the first headline then itself. It was the market that made the news. Mild green coming in for the frontline indices, mild red for Sensex actually. The mid-caps perked up in trade. That index gained nearly 1% after 2 days of underperformance the previous week. Reliance, TCS and HDFC Bank, the 3 heavyweights, tracked the Nifty, while Adani stocks recouped a part of their Friday losses. Prashant Nair joins in with today's action.
Well, it was neither here nor there for the benchmark indices, the Nifty. There was a bit of a movement in the first 1.5 hours of trade, and after that, nothing at all. I mean, actually, for about a few hours, the market was blinking red and green. Towards the close, there was a 20-25 point move, and that's the change that you see on the screen. Similar kind of price action for the Nifty Bank as well. Mid-caps and small caps improved, vastly improved in the last 60 minutes of trade, and more stocks went up as compared to went down. I'll get to stocks there in just a bit. Let's get to the Nifty gainers and losers. So gains include coming through in Cipla, Adani Enterprises, Hero, Tata Consumer, Divi's Laboratories, and Mahindra, which went up. In the broader space and long list of volume-led gainers once again. ICICI Securities, of course, the delisting playing through. Mazgaon Defense. I mean, actually, not just Mazgaon, but Garden Reach Shipbuilders was another one which did well. HCC, big blocks last week, big volumes participating today. Policy Bazaar, that is PB Fintech, had an analyst meet. Avas Financiers perked up. Parag Milk was a big gainer. Spark, JBM Auto, Saregama, Gillette, Friday big move, today big move, and something like a Genius Power did quite well as well. On the downside, from the large caps, Shree Cements perhaps was the only noticeable loser. It was down 10%, ended about 5% lower. You had in the broader space, Apollo Tyres, which lost. Landmark, which is the premium auto dealership, which lost. Rolex Rings came off quite a bit, and Credit Access was lower as well. So it's a kind of a holding pattern kind of a day, not very much to take away. The Nifty has held on to the 20-day moving average, although I think we'll need a day or two more of evidence to say that all is clear after last Thursday and Friday's wobble that we saw. Back to you.
All right, a couple of days of consolidation won't hurt anyone. In fact, only be better for the markets, given the sort of volatility that we saw in all of last week. But let's get you some market opinion as well. Jonathan Garner, who's the Chief Asia and EM Equity Strategist at Morgan Stanley, believes that there is India's ability to generate earnings versus other economy has steadily improved over the last few years, And that's what explains the premium that Indian markets trade at as compared to the world. Let's hear him out.
India did underperform early on in the rally, but a lot of that valuation excess had corrected by the time we got to March, so only about a 1.6 times forward PE premium then. Now, that is high compared to history, but do bear in mind that India's ability to generate earnings versus other emerging markets has steadily improved over the years. So paying about a 1.6 times forward PE premium is reasonable. And India has now participated in the rally. It's certainly not leading the rally. The leading market in Asia this year has been Japan, and Japan FX hedged has been our top pick in the region this year.
All right, and in more market opinion, Tahir Badshah, who's the Chief Investment Officer Equities at Invesco Mutual Fund, says that we might continue the good performance in broader markets for sure.
Might probably continue to see this a good performance and momentum around particularly the larger universe. We are seeing that the broader markets are doing very well and may continue to do so. We want to see the competitive advantages strengthen. We want to see the path to profitability becoming relatively more clear, and that typically becomes a case for us to look at them more constructively than before.
All right, to the second headline now. One of the stocks of the day was ICICI Securities, rallied over 8%, and this after a near 8 to 10% rally that we saw on Friday's trading session as well, taking the two-day gains of the company to be about 20%, as the company's board is likely to consider a proposal to delist shares from the exchanges this Thursday itself. This move is likely to see shareholders receive ICICI Bank shares as part of the proposed scheme of arrangement. Nimesh Shah joins in with the details of that one. Nimesh.
In terms of details, the ICICI Bank board meet is scheduled for 29th, and where they're going to consider the delisting of their subsidiary ICICI Securities. Now, ICICI Bank owns 75% and 25% is with public. Within that public holding, the two large holders are LIC, which owns 2.5%, and Government Pension Fund owns close to 3%. So the 6% of public holding will be very crucial to swing the delisting to go through. Now, what I understand from sources, this will be the first instance where the delisting proposal is been done with a scheme of arrangement, which means there will not be a cash buyout, but there will be a share swap with ICICI Bank. So the shareholders of ICICI Securities are likely to get the shares of ICICI Bank, with regards to the delisting of ICICI is concerned. So the swap ratio will be considered in the board meeting on June 29th, and that will be very important from an ICICI shareholder point of view. But first, in the first of its kind, the delisting proposal has been made by ICICI Bank, and this will all be done through share swap. So that's something to track on the June 29th. As I said, the ratio will be very crucial for the stock, for the ICICI Securities stock. But the key would be what is the ratio at which they're going to get the ICICI Bank shares. So that's the reason why the stock is up 10% today, and it was up 8% on Friday as well.
All right, Nimesh, thanks a lot for that. With that, let's move on to the third headline today. India's biggest drone maker, IdeaForge, launched its IPO today. The company aims to raise over 550 crores. The IPO has been subscribed by 3 times already. On day one itself, by noon, it was totally subscribed, and retail investors topped the bidding list by subscribing over 11 times. Vivek Iyer joins with more details of this IPO and the subscription. Vivek.
Well, that's right. It's a very interesting company, that's up for subscription. Like you mentioned, IdeaForge, it's the largest drone manufacturer. It's almost a 50% market share as far as the Indian market is concerned. As you mentioned, the issue opens today, ends on 29th, and the offer price is between 638 at the lower end of the price band to 672 rupees a share at the higher end of the price band. So the issue size is a total of 570 crore, where the primary issue or the fresh issue is of close to 240 crore, with the remaining being an OFS or an offer for sale by the promoters. What is the company raising funds for? From the fresh issue, they are looking to repay debt, fund working capital, as well as to invest in newer product developments. Now, talking about the company itself, the company actually had a 50% market share in drone manufacturing in FY22 in the Indian market, one of the largest players within the Indian market. And even globally, they are ranked 7th in terms of dual use category, that is both civil as well as defense drone. Motilal Oswal has written a note. What they're saying is that you could subscribe to this particular issue given the fact that you are likely to get a listing pop. They like the company given the complex wide product portfolio, presence in a niche space, strong client relationship with high entry barriers. Along with that, what they're saying is that the issue is actually quite reasonably valued at 5 times price to book value, which when compared to peers that actually trade between 8 times to 10 times book value on a post-issue basis, they believe it's a fair valuation, and which is why they like the company. Now, talking about the revenues, FY23 company saw revenues of close to 186 crore, profitability of close to 32 crore, EBITDA of 47 crore, and margins close to 25.3%.
In terms of responses to the to the regulators, we have already placed most of our responses to the regulators as well. And in terms of other facts, we do not have any facts supporting a lot of other claims. We have reached out proactively. When we look at the market opportunity, right, what has happened is that over the years, in fact, particularly post the pandemic, the opportunity has actually started to shift from being a good to have technology to a must have technology. And with the amount of impetus that both the government and the policy is doing for the industry, at this point in time, the potential is looking very exciting.
Our revenue is distributed between a defense and civil is how we demarcate the market today. Large part of past few years, revenue has been defense, while we see that the civil share will slowly increase.
All right, with those 3 headlines, what we'll do is take a short break. On the other side, we'll get you more with all the other headlines or all the other news that made headlines today. Welcome back. You're watching us here on Markets Today. We've been talking about the way the markets have moved today, the big IPO that was launched, and at the same time, ICICI Securities, the big gainer in the last couple of days on delisting proposals as well. Let's talk about the fourth headline for the day. It was from the IT pack. Infosys was the stock buzzing after it bagged a near $500 million order coming in from Denmark's Danske Bank. And this 5-year deal will entail Infosys acquiring Danske Bank's IT center in India itself. Rima joins in with this one. Rima, a big one.
Thanks so much for that. So a Nordic bank called Danske Bank has selected Infosys as its digital transformation partner. The estimated deal value is $454 million, spread over 5 years, with an option to extend the deal by 1 year for a maximum period of 3 years. As a part of this deal, the company will also acquire the captive center of this bank, which is based in Bengaluru and houses nearly 1,400 employees. And the cost of acquisition of this Bengaluru center will be about 16.3 crores. And the company expects this transaction to be completed by Q2 of this year, which means in the next 3 months. So it's a fairly large deal won by Infosys.
All right, Rima, hang in there with us. In fact, apart from Infosys, or rather apart from this order, Infosys also saw 6 exits since October. What could that mean for the company, and what are the key reasons for these exits?
Thanks so much for that. So, last week there was a media article which said the 2 senior vice presidents of the company had stepped down. One of them was Vishal Salvi, who was the head of cybersecurity, and the other one was Narasimha Rao, who was the EVP head of cloud and infrastructure. Well, it's not just those 2 exits, right? In the past, we remember Mohit Joshi was appointed as the CEO of Tech Mahindra. Then you had Kapil Jain, who was appointed as the CEO of eClerx. Go back last year, towards the end of last year, you had Ravi Kumar, who was the president of the company. He stepped down and he became the CEO of Cognizant. So since October of 2022, there have been 6 senior level exits. And most of these employees were old-timers in the company, having spent close to about 20 years in the company. And suddenly, we've had so many exits in the company. Well, the reasons we can only speculate. Some may want the title of a CEO, which may be difficult to come by in Infosys because Salil Parekh still has 4 more years. Here, 3 of them, Ravi Kumar, Mohit Joshi and Kapil Jain, were all given the CEO role, albeit at a smaller company, Tech Mahindra, Cognizant, as well as eClerx. So those could be some of the reasons, but the risk flagged off by the analyst community is that is there going to be a risk to delivery? Will project completion get, face some delays or troubles? So delivery execution could be a problem because 6 senior guys have stepped out in the last 9 months. Back to you.
Makes sense, Rima. Thanks a lot for that. So this is something that we'll be monitoring about Infosys and the IT sector in general. But we'll ask you to, take off your IT hat and wear the auto analyst hat. And that's because Apollo Tyres fell over 3%. And this despite the company reiterating their FY26 revenue target of $5 billion. What exactly happened out there?
So Apollo Tyres held its corporate day on Saturday. They also took the analysts to visit the Andhra Pradesh facility. Here the management reiterated its Vision 2026 plan. The goal is to achieve revenues of $5 billion from last year's revenue base of $3.1 billion, improve margins from 13.5% to more than 15%, keep the return on capital investment, the equity at 12 to 15%, and maintain your net debt to EBITDA ratio below 2x. But the reason the stock is a bit under pressure is the management on demand said that exports remain weak, and EU, that's the European Union region exports, is likely to remain flat in FY24. The company also indicated that they've lost 100 basis points market share year on year in the truck bus radial segment, and the current market share stands at 28 to 29%, and this is because the competition is lagging behind them by 1 price hike. So it's the concerns about the export demand which could be weighing on the stock, even though the company is quite confident about achieving its Vision 2026 plans.
All right, with that, let's talk about Shree Cement. That stock fell over 5% after reports suggested that the company was under the scanner for an alleged tax evasion of 2,300 crore rupees. The Income Tax Department had actually initiated a survey action at 5 locations of the cement manufacturer. However, the company has denied any evasion news, CNBC-TV18. In fact, they've also added that the income tax survey is still ongoing. Let's talk about the 5th headline for the day. PB Fintech jumped over 7% on the back of a positive brokerage outlook coming in from IIFL. They have a buy rating on the stock. Rima joins us back on the show. Rima, what does IIFL make of the stock?
So PB Fintech held its first virtual analyst meet since its listing. It was held on Friday between 11 and 3 p.m. And this wasn't an analyst meet where the company spoke about numbers. In fact, nothing on numbers, on the profitability, the guidance. It was more about showcasing the company's products, the technology, the use of AI. And the company, according to the IFL note, which we've accessed, and IFL attended that PB Fintech meet, said that 80% of the company's traffic is organic. They're using AI to improve the underwriting processes to reduce the risk. The company is also now able to penetrate into the previously underserved segment like the HNIs, which are the affluent segment. You've got housewives, the underprivileged. So IFL is quite bullish on the stock now. They have a buy rating with a target price of 750. And Morgan Stanley today has also extensively written on the internet space, and their target price is at 810.
All right, Rima, thanks a lot for that. Among the top gainers on the Nifty today was Tata Consumer as well, up almost 3%, and that's mainly because Citi initiated coverage on the stock with a buy call, and the target price is 1,020, which makes Citi the first on the street to actually have a target upwards of 1,000 on Tata Consumer, and target of 1,020 is actually the highest on the street itself. They valued the company at 56 times 2-year forward earnings, and their EPS estimate too is highest among the highest on the street. So they are really factoring in a blue sky scenario for the company. What is it that they're factoring? They're factoring in that the company's core will continue to strengthen going forward. Apart from that, they also expect, growth drivers like formalization of the market, them gaining more share from local players, their new products, the new categories that they've entered into with the expanded distribution to do well for them. They factored about 12% growth in their company's revenue over the next 3 years on a compounded annual basis. And, the profitability of the company would grow by about 22%. That's because the operating profit of the company would grow at 17% on a compounded basis over the next 3 years. New products, which is the mainstay of the company's growth drivers, would be around 27% of their sales as compared to 15% in FY23 itself. But they haven't, shied away from putting the risks on the table as well. The biggest risk, of course, is delay in demand recovery due to El Nino. The second factor is any sort of adverse movement in commodities as well as foreign exchange, to which Tata Consumer has a fair amount of exposure as well. And finally, competitive intensity could keep margin expansion under check. So those are a couple of factors we have to watch out for. That's a positive note on Tata Consumer. But let's move on. A negative note coming in on SBI Card caused the stock to tumble over 1.5% after Nomura has a reduced rating on the stock.
Well, that's right. So, Nomura has gone ahead and downgraded SBI Cards today, and the stock is under pressure. Now, what they've done is they've downgraded the stock to a reduced rating, and they've tucked the target price to quite steeply. The target price has been cut to 700 rupees a share from the earlier 1,030 rupees that they had. What they're saying is that as far as SBI Cards is concerned, the profitability is going to remain under pressure. Also, they're talking about the entire industry, and they're saying that the credit card industry growth is moderating quite significantly, with SBI Card continuing to lose market share. Along with that, what they're saying is that the industry landscape itself is changing with an increase in riskier consumer segments, and they're saying that the benefit of the policy rate pause or further cuts that may come in on the cost of funds is yet to be realized. Now, talking about valuations on an FY25 basis, the stretched valuation that SBI Card has at 5.4 times price to book and almost 26 times price to earnings is something that they believe does not leave much room for any error, and which is that they've gone ahead and downgraded SBI Cards today.
Vivek, thanks a lot for that. Let's talk about another very interesting note coming in from Morgan Stanley, and this is on India's internet sector. What exactly are the contours and the contents of that report? Surabhi joins in with the key takeaways. Surabhi.
Well, let me quickly take you through the highlights of this Morgan Stanley note. What they've done is that they have looked at the India internet landscape, and they've launched this report, and they promise to bring it out a little more frequently. They're analyzing internet companies in India on 3 parameters. One is growth and the outlook on growth over the next 4 odd years, margin levers and valuations. So what are the key observations? The first, MS says, is that there is a balance between growth and profitability that a lot of companies are striving for, and 3 of these companies stand out for Morgan Stanley. These are PB Fintech, Paytm and Zomato, and Morgan Stanley says that it is these 3 that are expected to lead this balance between profitability and growth over the next couple of years. The second trend is convergence in profitability across companies irrespective of the life stage they are in or the level of penetration that they have with respect to their products. The third is that profit is really driving stock upgrades or stock action. And we've seen that in the past. Morgan Stanley points out that a lot of the buying that we've seen in the last few months has been done by mutual funds, whereas foreign investors have been sellers. Let's talk profitability. Now, what are the factors leading to better profitability? Morgan Stanley says that it's improving contribution margins, for instance, better take rates for Zomato, or more revenue from adjacent businesses for something like a Paytm, lower marketing and promotional spends, better operating leverage, and curtailing losses in some of the side businesses, or basically curtailing those investments in the side businesses which were loss-making. Morgan Stanley is expecting the profitability trend to continue. It says that FY27 margins for Paytm, PB Fintech and Make My Trip could be above 20%. And by FY27, margins for Zomato, FSN, that's Nykaa, and delivery could be 11 to 14%. Their top picks are PB Fintech, Zomato and Nykaa.
All right. Thanks a lot for that, Surabhi. With that, it's time out on this edition of Markets Today. Thank you so much for watching. Stay tuned to CNBC-TV18 for more news and updates.